as you look across the preponderance of changes going on and your assessment of risks right now in the global economy, do you think that the Fed and the other central bankers have a good shot of a gentle glide path over the next 5 years, or do you think the road could be kind of rocky?
Well, I would say it's going to be quite rocky,
Okay.
not just for the central bankers, but for the financial market as a whole.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. The winds of change are blowing around the globe. 74 countries representing half of the world's population held national elections last year. Many of them, including the US, saw a replacement of the ruling incumbent by the opposition, often one promising a more nationalistic agenda. With so many new leaders and their accompanying new policies, what's the outlook for the global economy and financial markets here in 2025? To discuss, we've got the great fortune of speaking today with Richard Koo, Chief Economist at the Nomura Research Institute, as well as author of numerous best-selling books on economics. Richard, thank you so much for joining us today, all the way from Taiwan.
Well, thank you for having me here.
Oh, it's a real privilege. So this is the first time we've had you appear on this program, but it's a great honor. I've got a lot of questions for you, Richard, given your vast expertise in the field of economics. Very excited to talk to you as somebody with an ex-US perspective. A lot of the guests I have on this channel are from the US, so it's always very helpful when we can see through the eyes of somebody who is outside of the West. But before I get to those specific questions, if we can, let me just kick this off with a general question I like to start these discussions with. What's your current assessment of the global economy and financial markets?
Well, that's pretty broad.
Mm-hmm.
If I may start with the financial market first.
Sure.
I think we are going through a period where we are trying to come out of the leftovers from quantitative easing in so many countries, especially the United States, but others as well. And during the period after 2008, when we had a global financial crisis, so many countries adopted so-called non-conventional monetary easing measures, one of which was quantitative easing. And even though huge amounts of liquidity was injected, none of those central banks actually met their inflation target. So that shows that what we learned in universities, when the money supply is double, the price level will double, and all that kind of thing that Milton Friedman was associated with, was completely untrue after 2008 in the West, and actually after 1990 in Japan. Bank of Japan did all sorts of things, and nothing happened.
Right, all stuck in deflation, yeah.
And some people call it even deflation. And so we were in a very different world starting what I call, after the bursting of the bubble. Private sector actually were all minimizing debt because during the bubble period, they borrowed tons of money to leverage themselves up. Once the bubble burst, asset prices collapsed, liabilities remain, and they realized that their balance sheet's underwater. And your balance sheet's underwater, you're technically bankrupt, so you have to come out of it as quickly as possible. So everybody started repairing balance sheets, meaning paying down debt. And they were doing it even with zero interest rates. But in a national economy, if someone is saving, someone else has to be borrowing money to keep the economy going, right? If everybody's saving money and no one's borrowing money, the economy will just contract like crazy. And in the usual economy, central bank bring rates up and down to make sure that all the saved funds are borrowed and spent and the economy moves forward. But in the post-2008 and post-1990 in Japan, economies are all, the private sector sorts are all paying down debt, even at zero interest rates. And so we ended up with a huge deflationary gap. So Japan suffered that first, and Europe and the United States suffered that after 2008. And in order to correct that, the central bank tried to put in all sorts of money, liquidity into the system. But for that to work, someone has to borrow money to get the money out of the financial institutions and into the real economy. And we had very few borrowers, both in the West after 2008 and in Japan after 1990. So money got stuck in the financial sector, couldn't come out. inflation rates remained low, economy remained very weak for a very long time. But the central bank kept on adding these reserves into the system. And now the amount of excess reserves in the banking system in the United States is like 1,600 times bigger than just before Lehman, about 2,000 times bigger in Japan, and almost like 3,000 times bigger in the Eurozone. Now, the pandemic then came, inflation became a problem, so central banks start tightening monetary policies. But this is the first time in history where central bank has to tighten monetary policy with so much excess reserves already in the banking system. This never happened before. You know, Jay Powell often talks about Paul Volcker. I'm sure Paul Volcker is his hero. And I worked under Paul Volcker also when I was at the Fed. But if you remember how Paul Volcker tightened monetary policy to get inflation under control in the late 70s and early 80s, he was actually using a tool that Jay Powell doesn't have today. And that is that, you know, central bank has these two tools. One is to raise interest rates. The other is to tighten the availability of reserves. And these two, of course, not completely independent. They're very closely related. But at least you have two tools. And Paul Volcker actually used the second one. He actually tightened the availability of reserves in the name of controlling money supply. But the banks who don't have that much excess reserves got really scared that they might not have enough reserves to meet reserve requirements and so forth. So they was rushed into the interbank market, tried to make sure they have enough reserves. And that fight for reserves in the interbank market pushed the federal funds rate to 22%, if you remember that. Mm-hmm. And that killed the economy, that killed inflation, and that's how it was done. But today, with so much excess reserves already in the system, central banks, not just in the US, but in Japan and elsewhere, cannot use the second path of squeezing the availability of reserves. Everything will have to be on the interest rate side. But in the past, when we talk about 3% or 5% interest rates, we were talking about 3% interest rates with very little excess reserves. So that world is very different from the world we are in now, with 3%, with massive amount of excess reserves already in the system. And banks are so willing to lend because that's how you make money as a bank. Mm-hmm. And so the financial institutions failed to become tight in spite of this massive increase in interest rates. In the case of the United States, went from almost 0 to almost 5.5%. That should have had some impact. But as you know, share prices are all-time high, house prices are all-time high, consumption is still strong, investment is not that at all. That shows that we're in a very uncharted territory. How do you tighten monetary policy? How do you clamp on inflation when there's so much excess reserves already in the system? And I think we're all grappling with that. The Federal Reserve often blamed for being flip-flopping policies, but this is their first time facing this challenge. And the markets also, this is the first time. I mean, we pay all this attention to Federal Reserve policies, but in the end, I don't know how effective the monetary policy is when there's so much excess reserves already in the banking system, the liquidity already in the banking system. And I think that's what is affecting the financial market. You know, you see long bonds going from close to 5% and down to 3%. We're having in this cycle for quite a long time now, because every time a number comes out, people, and if it's strong, then long rates will go up. If it's weak, the long rates will come down. Mm-hmm. This is very, very unusual in the sense that in the past, central bank usually had some idea of where the economy is going. So just because the numbers are good or bad, the policies of the central bank, not just in the US, but elsewhere, well, more or less on a steady course, unless something really happens and then that forces them to make a U-turn or whatever. But this time, even central bankers are lost as to what is really happening. And so even, Jay Powell often says that, yes, we have this economic forecast, but we don't have very high confidence on it. When the governor of the central bank says something like that, you know that they kind of lost.
Mm-hmm.
And same is true for the market. And that's why we have to use this so-called data-dependent monetary policy.
Mm-hmm.
I was at the Fed myself, and what we were taught when I was at the Fed was that you're supposed to have some idea where the economy is going 6 months from now, because it takes about 6 months for monetary policy to actually start working.
Policy acts with a lag, yes.
Right, acts with a lag, that's right. And so you don't make your decisions based on what you see now. You base your decision on what might be the case 6 months from now, and then you calculate back. That's how monetary policies were decided in the past. But now, the fact that they're data dependent means that they're looking at the data from the past and try to decide for the future. Because the confidence level of the forecast that Fed people or Bank of Japan people came up over the years as being pretty bad. And so I think both the economy and financial markets, we are kind of feeling our way. What's really happening, because the past relationship between interest rates and economic activity or investment activity are not working very well today.
Okay, fascinating. And the Fed is fairly often criticized by its critics as quote unquote driving by looking in the rearview mirror. It sounds like you think that's probably, to the extent it's been true, very much true now on a relative basis. And it sounds like in this type of environment, the central banks are much more reactive than they would ideally like to be, right? They have to wait to see what the data is and then react to it versus projecting out what they think, with confidence, what's going to be going on in 6 months. So is it fair to say that this is an environment that perhaps you're more concerned about than more traditional times in the past from a central banking standpoint?
Well, I'm very concerned about it as a former central banker, because if increase in interest rates from 0 to 5 cannot contain house prices from rising. And this is not just the U.S. problem. U.S. you could say, well, there's a 30-year mortgage, fixed rate mortgages.
Right.
People don't want to move and things like that. But the same thing is happening in Europe as well. And Europe, mortgage rates are much more flexible.
Right. The standard mortgage duration's like 5 years, right?
Right, right.
Yeah.
And still, house prices are rising in almost all these European countries to the highest levels ever, except in Germany. So only Germans seems to have some sense. Everybody else is going crazy, as it were.
Well, so Richard, then if I understand you correctly, and this was very fascinating, so thank you for providing such a good description here at the beginning. You said the Fed largely has these kind of two tools that it uses to affect its monetary policy, but one of the tools isn't really working the way that it has in the past, and the Fed has a lot less control over it. Is this, to borrow a word from the Fed, is this a transitory situation, do you think, where, over some amount of time, quarters, years, excess reserves will get whittled down to something more historically normal and the Fed will regain more control over that function? Or is this really like a secular shift and it's a new world out there?
Well, I would like to call it transitory, except that the magnitude involved is just so large. As I indicated to you earlier, the amount of excess reserves in the system now is 1,600 times. That's 1,600 times.
That's bananas, yeah.
Than during just before the Lehman crisis. And so this thing has to be brought down for us to return to something that we're more comfortable with. And Jay Powell, of course, knows that, and he's still doing the so-called quantitative tightening. Even though he's bringing interest rates down, he's continuing with quantitative tightening. But it's going to take many more years before reserves are down to something that we would consider normal. And at least, well, this process will at least continue for maybe 3 to 5 years minimum.
Okay. And that's assuming there's no crisis in the
Right.
intervening time where the Fed might have to revert to QE or something like that. Yeah.
Yes, yes.
Okay, so help me and our viewers understand, and forgive me if some of these questions are fairly basic. But okay, so excess reserves are essentially um, where instead of lending money out, a bank can basically store money at the Fed and get paid on that money.
Right.
Um, and the Fed wants banks to have at least some amount of capital there in excess reserves in case the bank gets into trouble. Those reserves can be deployed in sort of a rescue measure. So is the big issue when excess reserves get too big that uh, it's so funny to me because I'm thinking, all right, if there's so much on excess reserves, then I would think there would be less capital for banks to lend out. But you're basically saying banks aren't impaired at all right now in what they're able to lend out, which is a little surprising to me, but I don't have the data in front of me. So when at least in the US, when we were going through, 2 years ago, we had a couple of big bank collapses and interest rates had shot up, where I was hearing that banks were tightening their lending standards. But if I'm hearing you correctly, it doesn't seem like since then lending's been that impaired in the banking system. Is that true?
Well, the Silicon Valley Bank and also a few other banks that got into trouble, uh, yes, they did get into trouble because of QE, as it were. Because during the QE, central bank kept on buying long bonds. Long bond rates came down, and these banks, thinking that buying long-term treasuries are safe, kept on buying at those, well, very elevated prices. But when the Fed started tightening, the price of bonds fell all around, and those banks that were holding those bonds were viewed with suspicion.
Right.
And
As people would say, their balance sheets were impaired because all of a sudden the bonds on their books were worth a lot less.
exactly, exactly.
Yeah.
Uh, I think that problem still exists. And one of the reasons Fed is bringing interest rates down, in spite of the fact that the economy is relatively strong and asset prices are going through the roof, maybe because they're worried that if they keep the rates high, more banks might run into problems. I don't know. They, of course, never come out and say things like that.
Right, right.
Former central banker myself, and I had to work with a number of huge banking crises when I was at the New York Fed. Uh, that problem is one of the reasons that may be affecting the Fed decision, that banks might run into problems. But overall, so far, if we take long enough time, if we manage to muddle through long enough, those 10-year bonds will eventually mature.
Hmm.
And the problem will become smaller and smaller.
Right. It'll self-correct, yeah, over time,
Yes,
given enough time.
right. People will be buying, bonds yielding 4.6% instead of those that were yielding only 2.2 or something. And so maybe that's what Fed is shooting for, to win enough time so that these banking issues will go away.
Um, oh, gosh, I'm getting pulled in several different directions of questions I want to ask you. I'm going to go for it on what you just said. So I can understand that strategy, right? But higher for longer, right? Which is, sort of what we are stuck with right now for the foreseeable future, right? Is a drag on economic growth, right? As the cost of capital remains higher than it was, the economy presumably can't grow as fast as it was because there's higher costs in the system of borrowing, right? So you're kind of trading off economic growth for protecting the banks, which maybe that is the Sophie's choice that the central planners have to make. But it does seem a little like favoritism. Like, well, let's keep the banks okay, and everybody else will just have to live with a diminished economy. Is that fair?
Well, actually, the fact that Fed is bringing rates down is helping the economy and helping the banks too, right? The Fed is,
Sorry, yes, and let me preface this. The banks, the Fed, I think would like to bring the rates down further. I think it would love to get the cost of capital down now, but it is, at least in the US, it is saying, hey, we have to start tempering our pace because inflation isn't quite slain yet. And of course, the bond market, as you said, has been taking yields in the other direction anyways. Um, so
I would say that, sorry, I would say
yeah.
that if Fed was purely looking at economic data,
Mm-hmm.
they might want to keep this rates higher for longer instead of bringing it down like we are seeing now. I mean, with the price of houses these days, which is a huge social problem in the United States as well,
Absolutely. Yeah.
and the share prices going through the roof, only benefiting those who have, and those people who don't have those suffering as a result. Strong dollar as a result of the very tight U.S. monetary policy,
Mm-hmm.
helping those people who hold shares, but those people who are working in manufacturing are suffering left and right.
Right.
And we still have unemployment rate at 4.1%, which is historically very low. And the consumption is quite strong still. In a classic central banking, I don't think people, central bankers will be lowering interest rates in the circumstances like this. They should
Right.
be really raising interest rates. But because of the weakness in the banking system, they might want to bring this thing down to basically save the banks and possibly to weaken the dollar a little bit because the dollar has been so strong and has not been good for the U.S. manufacturing.
Okay. And sorry, just let me help me just sort of understand again this core issue of too much excess reserves in the system. What is that preventing in the economy that you would like to see happening here? That if reserves were lower, it would enable. Is it more the Fed could do more of a Volcker type strategy to kill the rest of the remaining inflation, or what would you like to see if you were in charge of the system there?
Wow.
Yeah,
I will
around
continue.
excess reserves.
Yes, I think I will continue the QT, quantitative tightening,
Mm-hmm.
move this thing so that we're going return to the so-called normal monetary policy environment where the central bank actually have two tools
Yep.
to squeeze the availability of reserves as well as raising interest rates. We lost one already because of the
Yep.
QE, and so all the efforts are on on interest rates.
Right. Yep.
But if there are a lot of excess reserves, even if you raise interest rates, anyone who wanted to borrow money at slightly higher interest rates, banks would be so happy to lend because basically excess reserves is a money to lend.
Right. Yep.
In the past, when interest rate is 5%, and if someone says, I'm willing to pay 6%, give me the money. But if the banks don't have the excess reserves, the banks themselves have to go to the interbank market to get the funds. And that made it difficult for people to borrow money. That constraint doesn't exist now. Anyone who wants willing to pay a little higher than the federal funds rates can get the money right away.
Got it. All right.
And
So
that's
availability of credit is still too easy, if you will, in the system because banks have so much of these excess reserves that they're happy to lend them out.
yeah.
And that is perhaps supporting the economy in a way that the Fed monkeying around with the interest rate right now isn't as effective as it otherwise would be.
That
Okay,
means
so I get
to
that.
get the same
I'll let you
effect of
finish.
5%, you have to go to maybe 7% to get the same effect that you have 5% in the old world.
Right. Right,
That,
totally get it. So let me ask you this then. So, okay, so obviously, if we drain excess reserves or bring them down, and the Fed's able to use this tool more, it would be more effective in slowing the economy to bring the remaining stubborn inflation under control. What impact do you think that would have on financial markets? Because I've got to imagine, the economy is then unnaturally strong because of this easy credit that's still flowing out there. That liquidity probably does spill in some way, shape, or form into supporting markets. And markets are, depending upon what metric you look at from a valuation standpoint, are near or at record levels of valuation right now. So presumably this would this would cool off market prices if we were able to do this. How uh, how concerned are you today that we have such potentially overinflated markets that if this policy tool came back to the way you would like it to be, uh, the cure for getting inflation under control could still be really bad news for the markets?
Well, quantitative easing is easy on the way in, very difficult on the way out. And it's easy on the way in because, first of all, no one was borrowing money. They were all repairing balance sheets during that period. And so no matter how much you do, nothing happens. Inflation doesn't pick up, but nothing horrible happens either. And so they say, well, let's try more and let's try more. And then we ended up with these massive, about $3 trillion of excess reserves in the banking system. But when you try to come out, why are you trying to come out? Because the inflation is already there.
Mm-hmm.
So people are already becoming very nervous. And then you try to sell bonds into that market to absorb the liquidity. That's what quantitative tightening is all about.
Mm-hmm.
That will push interest rates higher. That could kill the banks, and all sorts of problems are there. And so it has to go very slowly and gradually to make sure that it doesn't disrupt the market completely. So if I were a central banker, I would be worried about the scenario where suddenly all these people who didn't borrow money after 2008 finished repairing their balance sheets, got very excited about, let's say, new deregulation or something from the new administration, and start borrowing money all at the same time. If that happens, inflation will become a real problem because the money will start coming out of the financial market. Those money that was stuck in the financial market will start coming out into the real economy.
Yep.
Inflation can pick up. Then the Fed will be forced to tighten very strongly,
very aggressively,
aggressively, and that can really cause some financial stress in the banking system and elsewhere. So I'm sure Fed would like to see economy recover, but gradually, so that they can remove this excess liquidity in the system also gradually.
Okay. And I'll have to go on Fred and take a look at the chart, but what is the trajectory of excess reserves right now? I know we have a lot more than we've had historically. It's grown to this massive size. Is it continuing to grow, or are they beginning to reverse it through QT and some of their measures?
Well, QT did bring down monetary base significantly, but because the base is so high, you have to continue going for another 5 years or so at this current pace before we will be anywhere near where we were before.
Okay, so they've at least peaked. The trajectory is in the right direction, but it's going at such a slow pace. We're going to need many, many more years at the current pace to get back to where we really should be.
Yes, yes.
Yeah. Okay. All right. Super interesting, super useful. And again, as we mentioned earlier, that glide path, that half a decade glide path, sort of as one where you cross your fingers and you hope you get there with no issues in the meantime. As you look at the current landscape, I mentioned an issue about markets being very overvalued. I also mentioned too that we have all these countries around the world that just replace their leadership. Many of these leaders have different ideas of what to do with the country and its trade relations than the previous administration had. As you look across the preponderance of changes going on and your assessment of risks right now in the global economy, do you think that the Fed and the other central bankers have a good shot of a gentle glide path over the next 5 years, or do you think the road could be kind of rocky?
Well, I would say it's going to be quite rocky.
Okay.
Not just for the central bankers, but for the financial market as a whole. For example, if Mr. Trump goes through with this across-the-board increase in tariffs, the past rules on tariffs, I'm afraid, are not going to be very useful this time around Because in the past, the tariffs were directed to certain countries in a certain ranges, but that allowed those producers that are making the same product where the tariff is applied to move their productions to some, or if you're making in China, you move the production to Vietnam, and then with less tariff, things can come in. And that allowed US inflation rates from really rising all that much. Or other competitors will take over your market within Asia, for example. And so US prices did not go up as much as the tariff numbers suggested. But if tariff goes up across the board, and suppose you're Asian manufacturing, let's say you're in South Korea, but you know that the Taiwanese are facing the same problem, the Chinese are facing the problem. So it's much easier to raise prices in the United States than before. And so that could actually affect inflation much more than the experiences of using tariffs in the past, where it was more selective and it was more targeted. So if you're a central bank and if new administration is talking about across-the-board tariff increases, then you have to start thinking about what that can do to prices that are much more serious than in the past.
Okay, so when President-elect Trump, says, "I love tariffs, and don't worry, they're not going to be inflationary," it sounds like you would say, I might have a different opinion on that.
Especially if it's across the board.
Yeah. Okay. All right. So let me ask you this. So when I talk to other experts on this channel, and I kick off with that original starting question of their assessment of the global economy, most of them come back and say, the U.S. is kind of doing the best of the other major countries out there. And they're painting with a broad stroke. There's some good success stories out there, India, being one of them. But more or less, the U.S. is kind of doing the best. It's in the best position. There's a lot of global capital flowing into the U.S. markets. One of the countries they say is in probably some of the biggest challenges ahead of it right now is China. And you're located out there in Asia, and I believe probably have a better beat on what's truly going on in China than most of the people that I talk to. You mentioned earlier too that when we were coming out of the global financial crisis, the Great Recession, that a lot of countries are in what I believe you call a balance sheet recession, right? Which is where, as you were saying, households and businesses divert more of their income towards paying down debt versus investing or consumption, right? And as you were saying, as one part of the world prioritizes saving and debt pay down, someone else has got to be doing the borrowing, right, to keep the system working. And it was China, I believe, that did the lion's share of the borrowing coming out of the Great Financial Crisis. And in many ways, people kind of look at that and said, that's what pulled the world out of the Great Financial Recession, right? Now we're at a point where China has really levered up and it's got a lot of problems going on right now. I guess two questions. One, what's your current assessment of China and its prospects? But two, if growth starts slowing down again in other parts of the world, like even the US, is there somebody there who can take the baton, or is the global economy more vulnerable today than it was in the past?
Well, I will say the latter is likely to be the case, in that, yes, China, I think, is in balance sheet recession. And for the benefit of audience, let me quickly explain what balance sheet recession, how it operates. In the usual economy, as I mentioned to you earlier, if there's a savers, there has to be borrowers, and the central bank bringing interest rates up and down to make sure that all safe funds are borrowed and spent. That's basically how economies operate. But once big bubble bursts, asset prices collapse, liabilities remain, people start repairing their balance sheets all at the same time. And so even if central bank bring rates down to zero, these technically bankrupt borrowers will not increase their borrowings. They will continue to pay down debt. And that means you end up with excess borrowers, excess savers. and that starts killing the economy down, depressing the economy. And United States and Europe actually entered this after 2008 when the housing bubble burst. So in this environment, you bring interest rates down to zero, nothing happens because people are still repairing balance sheets. And the only way to keep the economy going in environment of that kind, that type, is for the government to borrow money. If government borrows money and spend it, then you can fill the gap. So if I may give you a numerical example, if I have $1,000 of income and I spend 900 myself, 900 is already someone else's income, so that's not a problem. $100 that I saved will go through the financial system and go through the process that I just mentioned to you earlier. Someone borrows the money with appropriate interest rates, then the total expenditure in the economy will be 900 plus $100,000 against my original income of $1,000, and the economy moves forward. That's the usual textbook economy. But in the balance sheet recession, $900 is spent, but the $100 that comes into the financial sector gets stuck in the financial sector. It cannot come out because people are no longer borrowing money, even at zero interest rates. Then the economy shrinks from 1,000 to 900 because only $900 is spent. And if the person who gets that 900 says, okay, let's save 10%, spends 810 and save 90, that 90 gets stuck in the financial system again.
Right, it's like a vicious cycle, yeah.
Right, it takes a long time to repair balance sheets if the bubble was really big. US, after 2008, actually realized, especially Chairman Bernanke of the Federal Reserve realized that this is balance sheet recession. So he warned the Congress not to cut the budget deficit, or if we did, we're going to fall off the fiscal cliff. Remember that line, fiscal cliff?
I do.
United States is the only country that learned from the Japanese experience, because Europeans refused to learn that, and they all fell off the fiscal cliff. And that was actually really devastating for countries like Spain, where unemployment rate shot to 26%. And they're still kind of recovering from that massive damage. Whereas US did not fall off the fiscal cliff, did all the right things after 2008, not before, but after 2008. So it came out much faster. And now, after 16 years, people are beginning to borrow money, which is a good thing. This is what we've been waiting for. This is a recovery from balance sheet recession. And that's why we are faced with this problem that we just discussed earlier. How do you tighten or normalize monetary policy when there's so much money in the system? Now, the Chinese are aware of the fact that they are in balance sheet recession. I know that because all of my books, all of my 5 English books were translated to Chinese. All of them became bestsellers. Somehow I don't get any loyalties, but that's what it's all about. So they are already aware that they contracted this disease because the housing bubble burst, people beginning to pay down debt. But for the government, they were actually running a huge deficit even before the balance sheet recession happened, starting last year, 2023. And if you put the local government and central government together, if you look at central government, the budget deficit doesn't look very worrisome. But if you put them together and call it the general government, budget deficit was already 7% of GDP before the bubble burst.
Wow.
So if you start from -7 and you still have to add a large fiscal stimulus on top of it to keep this thing going, you might be talking about, budget deficit 10, 11% of GDP. And anyone who looks at the budget deficit, 11% of GDP or 12% of GDP gets freaked out. And they said, no, let's try something else. And that's basically where the Chinese are today. They know what disease they contracted, but look, starting point of large budget deficit to begin with, especially with local governments all technically bankrupt. They are still trying to find a ways to go around this problem by doing structural reform policies or export drive or other things that may allow them not to increase budget deficit more than this current very high level. That's where the Chinese policymakers are today.
Okay. What kind of odds do you give them?
Or at the end of the day, I'm sure they will do it. They would put in the necessary fiscal stimulus because one way to come out of balance sheet recession without using fiscal stimulus is exports. But Japan was in exactly the same situation 30 years ago. Japan was in horrendous balance sheet recession, but it has so many industries that are competitive around the world. So they wanted to, export its way out. But at that time, Japan was the largest trade surplus nation in the world. And if you remember 30 years ago, U.S.-Japan trade friction was really, really serious and
Yep.
ugly. I remember that very well because I was on the American side at that time, trying to convince the Japanese public that it's in their own interest to accommodate U.S. demands to open markets, because otherwise this thing will push the yen higher and higher. And that's basically what happened.
It happened. Yeah.
China is
Um,
in the same situation, so they cannot really rely on exports if you're the largest trade surplus country in the world. And so they have to do more domestic demand stimulating policies.
okay. So you think they'll do what they need to do, but it took Japan, and of course Japan kind of was the first one to really fall into this at an extreme
Yeah.
level, and everybody's tried to learn from them. But it's taken Japan essentially forever to get out of its balance sheet recession. What sort of timeline do you guesstimate China will take here? Are we talking a year or two? Are we talking a decade or more?
Well, you have to understand that Japan's bubble was absolutely huge.
Gargantuan, biggest asset bubble ever, right? Yeah.
Yes. Imperial Palace Garden in the middle of Tokyo. I don't know how many times you visited Tokyo, but this size of slightly smaller than maybe Central Park in New York.
Hmm.
That thing was worth the entire state of California at the peak of the bubble. So you can imagine how crazy the Japanese bubble was. So when that thing burst, commercial real estate prices fell 87% nationwide, not just the corner of Tokyo, the entire country. Now try to imagine, New York, San Francisco, Orlando, everywhere down, Chicago down 87%.
Yeah,
What kind
it's
of
almost
economy?
unfathomable. Yeah.
What kind of economy you got left in the United States, right?
Yeah. Armageddon
Yeah.
one. Yeah.
Japanese GDP never fell below the peak of the bubble. It was always about the peak of the bubble throughout this last 30 some years. And that's because the government borrowed the money and kept the economy going. And so even with a massive bubble, if the government does the right things, you could keep the GDP from falling. GDP not falling means people have income to pay down debt.
Hmm.
And if you do the right things from the very beginning, you should be able to come out of these things. Well, in the Japanese case, minimum 10 years, given the size of the bubble. Now, size of the bubble as a percentage of GDP in China is probably smaller than in Japan. And so if government does everything right in time, then maybe 5 years plus. But if they keep on delaying as they are doing now, it could get much longer.
Okay. So, I just sort of remember at the beginning of 2024, there was a sense of, oh, China's, finally getting its act back together. They're going to start really contributing to global GDP growth. They're going to really kind of start to help us out again. And it's been a big disappointment. And I kind of hear you say, don't pin your hopes on China anytime soon, that eventually they'll work their way through this, but it's going to take them a number of years.
Yes.
Okay. All right. Well, look, I'm realizing I've got a way more questions for you than we have time left, so I'm going to start getting really surgical here. Um, so, uh, I guess just to give you a chance to um, synthesize things for viewers here. Yeah, I detect from you, Richard, sort of a sense of both optimism that the central planners are going to get us out of the current jams they're in, given enough time. But I also hear some concern, in the tone of how you're describing all this. As you look forward to 2025 and you look at the global economy, is this going to be an on the balance good year or less good year, do you expect?
Wow. I guess that depends on where you are in which
Yeah,
industry.
yeah.
If you are in manufacturing in the United States, for example, maybe with tariffs and things like that, it will be a good year.
Mm-hmm.
But whether that's a good year for the rest of the United States with prices rising and more trade frictions, supply constraints of all kinds, it might not be a great year if you are dependent on foreign suppliers, for example.
Mm-hmm.
Overall, the balance sheet problems that affected so many countries after 2008, that problem, if you give them enough time, will be resolved because people are repairing balance sheets diligently. US was out long ago. Europeans are perhaps gradually coming out. Japan came out maybe 10 years ago from the massive bubble that they suffered. But we still have another problem here, and that is that those people who go through this balance sheet repairs, because it's such a painful experience, after they finished repairing their balance sheet, they say to themselves, oh, that was terrible. It was such a stupid thing of me to have borrowed so much money during the bubble. I will never borrow money again. And if you remember the Americans who lived through the Great Depression, they never borrowed money until they died, right? Because the experience was so bad. We have that problem in Japan still, after 30 some years. Many Japanese corporate executives will say, I never want to borrow money again. That was so bad. So we have in Japan this term, cash flow management, or in Japanese, it would be cash flow management or something like that. In English, it means if you have a certain amount of cash flow, okay, you put some in the bank account, some in less liquid, some liquid assets to balance return against a liquidity risk. In Japanese, the exact same word means do everything within cash flow. Don't borrow money, period.
Yep.
And that kind of mentality, I think, is happening in Europe because they did fall off the fiscal cliff, suffered very badly. So even after their balance sheets are repaired, my guess is that most Europeans will remain very averse to borrowing money, just like we're seeing in Japan today. And some American consumers, households, after 2008, may be also suffering from the same problem. And so borrowing demands will probably remain relatively weak, which means monetary policy will not be all that effective. But at the same time, if the private sector is not borrowing money, fiscal policy will be very effective because the crowding out problems do not exist in this kind of environment. Whatever the government spends will have an immediate impact on the economy without discouraging private sector sources from not borrowing money. And so I think we should be paying a lot more attention to fiscal policy developments in all these economies because private sector sources are not borrowing money. Averse to borrowing money, even without clean balance sheets.
And
pay less attention to the monetary policy.
Is the simple way to say that is you think that the fiscal spending or the fiscal side in many countries around the world, you think it would be good for them to be spending more fiscally than they are right now because the consumer's not borrowing as much?
Especially for those countries like Europe and some still in Japan, where private sector is not borrowing all that much relative to the level of interest rates, then the government should be more active in borrowing money to make sure that all the saved funds are borrowed and spent.
Yeah, okay. I can get the logic of that. I got to say, being an American here in America, it does not feel that we have been sufficiently burned from any of the crises since the dot-com one, that we've changed our behavior. I think we're still very speculative and willing to borrow really almost anything we can get. And our fiscal authorities have been spending like crazy too over the past recent years. So I'd love to get sort of your reaction to that as somebody who actually looks at the aggregate data. But I think the fact that we've had 3 really big asset bubbles in the past 20 years sort of is a pretty good indicator that we have not been burned enough to learn our lesson because we seem to be repeating this behavior.
You asked me whether this is secular or transitory.
Yeah.
There is one factor that is making this problem secular, and that is that the share of manufacturing in all these developed countries have shrunk quite considerably with globalization. And this is important because manufacturers tend to borrow lots of money for their fixed capital investments.
Mm-hmm.
The
Yep.
house sector saving, manufacturers borrowing, and that's how economy was growing very rapidly during 50s, 60s, and 70s. Now the manufacturing share of borrowing is minuscule. And so if you're a fund manager in US institutions or Japan or elsewhere, and your traditional borrower is no longer borrowing money, but you still have to place this money somewhere, you ended up, and if the private sector is not borrowing not enough, then you ended up buying existing assets, right? Houses or whatever that's going up in value.
Right.
And so that is a secular problem. And that is the reason why we are seeing so many bubbles in the last 20, 30 years in the developed world, because the traditional borrowers are not borrowing money, but the fund managers still getting all this money from the savers to invest, have to put this money somewhere. And I think this is something that we really have to work on. That is to say, whether the government should come in and borrow these funds to keep the economy going or not. Because this is all the economics we learn in universities are based on the world that exists in the 60s and 70s, right?
Right.
But that world doesn't exist anymore. And so
this is super fascinating. So do you see us going from here? I mentioned in the US at least, you look at the Buffett indicator, you look at PE ratios, things like this. They're at historic extremes or all-time extremes. Do you see this as just continuing to happen, that we're just going to go from bubble to bubble to bubble going forward for the foreseeable future? Or do you see there being some sort of corrective event that is so painful that we start actually changing our behavior? Because like in the Depression, people just got so burned, they're like, I don't want to do that again.
So we are going to go from, if we do nothing about the situation, I think we're going to go from bubble to balance sheet recessions, suffer many years, and then another bubble because there's so much money in the system, and then balance sheet recession. So bubble and balance sheet recession coming in and out. If there's some technological development that suddenly gets everybody excited, and we have to invest to do this and that, then
AI.
come out AI maybe.
Yeah.
Maybe we can come out of this cycle. But if we, even with AI, we don't get enough borrowings to offset the private sector savings, then maybe the government, I mean, this is a long shot, but maybe the government should come up with a group of wise men and women, put them in one room, and let them come up with those public works projects that earns the social rate of return that's higher than the 10-year government bond.
Got it. Yeah. So maybe we build a bunch of small modular nuclear reactors, and that employs a lot of people, and it provides the data to power the AI boom. Something like that, right?
Right. As long as those projects earn the social rate of return higher than, where is the U.S. Treasury now, 4.7 or 4.8, then that's not a burden on future taxpayers, because that's self-financing. Then the fiscal policy can continue like this to keep the economy going.
Okay, fascinating. All right, well, I'm going to start wrapping up here, given the time, and thank you for giving us so much time, Mr. Koo. So you're an economist. You're not really, to my knowledge, a market analyst, market predictor. So feel free to punt on this question, but do you have a general outlook or expectation for the financial markets in 2025? We've had two, at least in this US, we've had two phenomenally good years. As I mentioned earlier, a lot of global capital has been flowing into the US, and that's really been helping accelerate the markets here. Of course, we have the AI boom going on. Do you expect more of the same, or for whatever reasons, whether it's the stretched valuations I mentioned or whatever, do you expect that 2025 could potentially be a quite different year than what we're now accustomed to?
if Donald Trump's first term is any guide, he really talked about trade deficit in his first term almost every day. That kept a lot of investors from bringing money to the US because the best way to remove trade deficit is to bring the dollar down. Donald Trump never mentioned bringing the dollar down, intervening in the foreign exchange market to bring the dollar down during his first term. But the thought that that can happen kept dollar from appreciating. During the first term, at the beginning of the first term, there was also a so-called Trump trade, if you remember. The dollar was actually quite strong because people thought the US economy would be strong and so forth. But once he entered the White House, the dollar became very stable. It actually fell on many occasions, in spite of Federal Reserve raising interest rates 8 times in the process. ECB, Bank of Japan, did nothing during the period. Fed raised interest rates 8 times, and the dollar remained shockingly stable, actually quite weak, thanks to Donald Trump mentioning trade deficit every day. That can happen this year too. I don't know whether he will do the same thing, but I know he's committed to reducing trade deficit because it costed the U.S. society so much. I calculated how much GDP was lost as a trade deficit over the last 43 years. It was 153% of U.S. GDP, about $41 trillion in today's dollars. If you lose that much GDP as a result of trade deficit, so many people will be unhappy. And those are the people who probably voted for Trump.
Right.
If he wants to do something about these people, he cannot allow the dollar to remain strong. And that can have implications. If the dollar remains stable, it's not going to be a big shock to the markets. But if the dollar starts weakening, that could raise U.S. interest rates, right? Because if the foreigners are buying U.S. treasuries, and if the foreigners stop buying U.S. treasuries, that could add to interest rates in the U.S. Those would be the things that I'll be watching out for this year.
Right, and presumably if foreign capital flows are helping support U.S. markets, if that capital flows start slowing at least, because they're worried about the currency exchange risk more, that's another contributor, apparently. Yeah, okay. This is kind of a wonky question, so feel free not to answer it, but I'm just looking for a very short answer. I've heard it often said that, well, hey, if I think this is Triffin's dilemma, right? That the country that has the world's reserve currency will de facto have to run a trade deficit. So how much of what the U.S. has been losing, over these decades, that large number you mentioned, presumably we can't save all of it, right? Given Triffin's dilemma, is that true?
I don't think that's true at all. I mean, this could have run the trade balance with the dollar at appropriate levels all these years. But after the Plaza Accord, 1985, which I was indirectly involved because I was at the New York Fed foreign exchange desk just prior to that, the US government somehow decided not to do anything about the dollar. And the dollar remained quite strong for all these, I would say, 37 years after the so-called Nomura Accord. Plaza was 1985. And when the dollar adjustment was completed by 1987, G7 countries agreed that everything was fine. We are happy with the dollar adjustments. So they had a Nomura Accord. That was 1987, February. From that point to the present, both Republican and Democratic administrations did nothing about the dollar and allowed the dollar to remain strong. The U.S. kept on running deficits. That can finally change this time around with Trump. But when the dollar was adjusted back in 1985 to 87, there was no major problems in the U.S. market. And pickup in inflation was not all that great either. And so I think these things can be put in place. And if you do it correctly, I don't think we have to worry about major disruptions in the market that a lot of people feared when the Plaza was put in place in September 1985.
Okay. And you think net over time, it would be a big boon to the US, just given the fact that you're not bleeding all that out anymore, correct?
Yes, yes.
Yeah. All right. Well, look, Richard, it's been a real privilege to be able to talk to somebody of your experience and your expertise. Thank you. As I promised, I'm going to end it here on just the hour. One last very important question for you, which is for folks that have really enjoyed this interview and would like to follow you in your work, where should they go?
Please contact the nearest Nomura office,
Okay.
Nomura Securities office.
All right, fantastic. And is there a website, Nomura.com or whatever? If there is, I'll put it up on the screen when I edit this.
Oh, okay. Well, Nomura has a few branch offices in the United States as well, New York in particular. So please use
Please
those.
go there. Okay, fantastic. All right. Well, folks, if you are as appreciative as I, please show Mr. Koo that by hitting the like button and then clicking on the subscribe button below. Richard, again, it's really been a privilege. Thank you so much, and very much looking forward to having you back on this channel at some point, perhaps in Q2, if your schedule allows, to get an update from you when we know a little bit more about the new administration here in the U.S.
Oh, that would be lovely. Thank you very much.
Thank you so much. Everybody else, thanks so much for watching.
Thank you.